Now we pivot over to the international world, and we really have to start with Russian flows and what is happening within Russia itself. So, as we get ready for OPEC's meeting next week, it's likely they're just going to sit still again, just because as they head into the meeting, we've had another 400,000 barrels a day come off the market because of the spat between Kurdistan and Turkey, which again, 400,000. The pipeline typically goes 410, 450, but let's just say, roughly speaking, 400,000 barrels a day is no longer going up because they're trying to go back and forth on rates and tariffs and whatnot. So that is going to disrupt things. Now, it should be a bigger issue, but it's not as much because of the European slowdown driven by political unrest as well as other issues at this point in time. So again, those are some pieces that we have to look at, but it's still going to be a meaningful adjustment in general as they go to their meeting, because based on what I'm seeing, and please correct me if I'm wrong, I don't see any clear path in the next week or two. So this is something that will definitely prolong, but it's important when you look at Russia, because now Russia has talked about reducing production, but yet exports are the same. And that's what we keep talking about, where their production isn't as important as how much exports is going out. If they really wanted to damage the world in terms of crude pricing, they wouldn't cut production, they would cut exports. And that's the caveat that we want to look at, is because they have to cut production, because they have to reduce refinery run rates, which then puts more crude into the system that really the only way out is by export, and their physical exporting infrastructure is already taxed to the breaking point, and they don't have a huge amount of storage. And you might say, it's like, oh, well, why not? Because they have a lot of pipelines. So typically, they don't need a lot of storage, because the crude goes directly into the pipelines into the rest of Europe. And now that has been, obviously cut off, that's where we're starting to see some of these underlying issues, which is why when you look at Russian diesel flows, they're surging, because again, that's also not going into Europe. So it has to go into another market. And you can see it's increasing, and we expect this to continue to go higher, highest since at least 2016. And it's just because of data availability. AIS transponders were harder to get information on prior to that, and now as it became more readily available, and at least the way to process the data is more readily available, it's easier to see what's happening, which is where there's a lot of diesel in the market, and there's not a whole lot of demand, given the shifts in the economic playground. But if you had a choice between Russian diesel and other diesel, well, as long as you're not following the sanctions or this price cap, you're getting diesel at a significant discount. You're looking at something that's almost, $40 cheaper than the alternative. So you could buy Northwest Europe, you could buy other, or you could buy Russian diesel, which is significantly discounted. So the fact that it's discounted to this level and still going into storage kind of gives you an idea of where that market sits on a global basis, which is why we're cautious when you look at some of the different flows. I know some people, and others like to only look at the U.S. markets, because obviously U.S. Storage is low on the distillate side. Gasoline is in a decent spot compared to historics. But then the moment you look abroad, you're like, well, the world changes a little bit in terms of some of the different flows. And that's why we talk so much about what's happening abroad, and then that is going to drive some of those physical prices, which we've seen come under pressure. The Middle East it still remains elevated when you look at floating storage, and a lot of that is being driven based on the demand side, where you're not getting new demand. People are taking their term, they're not asking for more, and that's again, keeping some of these flows and some of this product stuck in the water. We got Saudi Arabia increased their relationship with China. They bought into Saudi Aramco bought into another refiner with China. This is now the second one in the last 2 weeks, and they've done this before. And again, it's the joint venture side because China needs product, but at the same time, China needs know-how, and you're not going to get it from the U.S., so they're going to try to get it from Saudi Aramco. But it doesn't mean that China is still going to buy a significant amount of Russian crude. So even though they're increasing their cooperation, it's hard to fight against that Russian discount, and that's one of the things. Now, the other piece, the thing that has been talked about, the only thing that has probably been talked more recently than it needs to be is the death of the petrodollar. So I'm sure you've heard it. The petrodollar is on its last leg. They're going to start trading in yuan. And it's like, okay, well, first off, Saudi has been pegging their currency to the US dollar since 1987. That's not something that goes away anytime soon. The US dollar is still the best hedge, especially on a treasuries basis, against inflation versus where other levels are. There's still a concern about, tying yourselves to China and what that would mean in terms of some of those economic backdrops. But also, I think it's also important to look at, reserves are still in dollars, reserves are still in treasuries, the peg is still against the dollar. If Saudi were to say we're getting rid of the dollar peg, that would be more shocking and be like, oh wow, we really are going to see the end of the petrodollar. But we're not. And the reason why is because another three key pieces, Russian product, when you look at Russian, military sales, you have India canceling sales because you're seeing the failure of their equipment. You're seeing they're also struggling to make enough equipment to even supply their own troops, let alone sell it to others. So the F-16, U.S. military jets are still the premier going into Saudi. The Saudi military, Patriot missiles are the ones protecting all of the facilities, and the U.S. Navy is still the one maintaining trade lanes. So as long as those things exist, it's going to be difficult to say the petrodollar is ending. And now when you then take it to a much bigger geopolitical position, you have parts of the GCC that have normalized trade relations with Israel. You're looking at India and some of these countries creating more trade relationships because they're looking at ways to essentially go into the Middle East and then straight into Europe. And this new shift, or the new Silk Road, if you will, and let's just say India and China don't quite get along, and India's moving closer and closer to the US and the West versus Russia, given some of the different backdrops. So again, there's a lot of things to counter some of these views that the petrodollar is ending. Now, when we look at things in terms of US flows, US exports have come down a bit, but you can see they're, they're still at the highs, but they're still above pretty much what we can physically do. And a lot of that is just driven based on timing delays of getting product out of the market. So again, we're still saying that we're about that 3.8 million barrel a day export level. Now, when we start looking at gas oil crack spreads in Asia, you can see that it's weakening again. And this is the concern that we have when we look at the international markets, because you have significantly discounted Russian diesel, gas oil, and you now have China that has had some steady exports, and you have a slowing economy. So at what point does this get to a level, and when we look at this, it's closer to $17, where refiners are going to have to make a decision, and it's going to reduce economic runs. It's going to create economic run cuts, which will then reduce the amount of crude demand coming into that world, which again will put pressure on some of those levels. Now, when we look at what's happening with Dubai and Brent, you can see that the price has come down considerably, sitting here at about 85 cents. And when you look at how extreme things have gone, you're seeing some of these different breaking points between the two, and it's just because there's not the same level of demand that we've seen in previous periods, and you're getting more and more product getting put on the water in the Middle East. Global crude oil on the water continues to be elevated. Again, we don't see that changing. Crude oil in transit still remaining elevated, but starting to slow. So as it slows, we're going to see some of this crude being moved into floating storage, which again is shifting higher. So as it comes out of transit, it goes into floating storage. And that's why, we were assuming that floating storage is going to be similar to 2022. You can see it's come back up. But again, we just think it's going to normalize as you get some of these underlying shifts. And a lot of that is because of Asia. So Asia has seen their floating storage come down, but we see this reverting back and closer to 2022 levels because you have the supertanker crude imports. You had that nice big spike. Now you've seen the slowdown in buying, and that's going to, again, just take time to see that come in, and that will again, put some of that into floating storage. Not a huge amount, but again, just remaining above what would be deemed normal. But it's important to appreciate that even during this big spike in Chinese buying, you actually had physical prices getting weak and weakening. So it just gives you an idea that even as China buys, others aren't. And that's that back and forth that we keep talking about in terms of, yes, China's reopening, China's demand will inherently go up, but what's happening around China? And that's where we continue to see some of those headwinds. When you look at the congestion side, one of the things that we said is that it was going to move along seasonal lines just at a much better number. And that continues to play out. We see some of that trending back down, but still going to stay above that 2019 line, which is, that index to 2021. And that's a good thing. Again, it's just kind of getting back to that normalcy when you look at it against the historics. Now, when we look at China's Shandong, you can see that there's a bit of a slowdown going from 75.7 at the peak to 62.6. Some of that is just turnarounds. We do expect that to turn back up as we go through the next few weeks. And that's when it's going to come down and then again get back to about 67 to 68%. But it'll be slower just because the demand in China is underwhelming, and that's where they're trying to balance what's in storage, because there's still a lot of product in storage, how much of the export quotas have they used, and then what's the cost of crude. So again, there's a lot of these balancing acts when you look at underlying flows. West Africa, as we've been saying, has been struggling. It's back to the seasonally adjusted highs. It's actually at the highest level in 2023 and back to the peaks that we've seen in 2022, which again is becoming a bigger problem, and all the more reason of, because West Africa is the biggest reason why there hasn't been a whole lot of activity. And again, the OPEC being below the quota, and based on these storage numbers and floating storage numbers, there's no reason for them to increase, especially as you see, based on these levels and the increase in floating storage, they continue to cut pricing. Now, when we look at the U.S., gasoline exports dropped 66,000 barrels a day, still above the 5-year. Distillate dropped 199,000 barrels a day, now below the 5-year. Again, they're just going to kind of balance right around those numbers. Propane dropped just 2,000, but still very strong and well above the 5-year by 635,000, with total crude oil exports slowing. But a lot of that is that timing delay, and we should see that continue to normalize. Now, when we look at gasoline exports, again, just kind of balancing, it's going to remain at the higher end. Mexico slowed down a bit. You have more of that Russian product kind of coming in. You have that, again, more of that economic problem, but the U.S. has to balance, storage. And that's, again, going to keep us above the 5-year, just move us a bit closer to where the 5-year average is. And now when we shifted to diesel or distillate, you can see that on a seasonal basis, there's normally a bit of a drop. We just think it's going to stay right around the 5-year average, if not slightly above, as they try to balance their storage between, especially with PADD 3 refiners ramping up and trying to get some of this into the market. There still is a better market abroad than local. So it's just a matter of trying to, again, play those different markets. Crude oil exports remaining, again, very high, but will keep coming down. Then when we look at propane, propylene, still staying at all-time highs. There's still a demand out there, and LPG is a very good proxy for some of these movements where, you've seen a lot of adoption of LPG over the last decade, and it continues to move in that direction from a petchem level, from a domestic and residential, as well as a commercial use. And that's, again, as the U.S. continues to be the dominant force based on pricing as well as volume, because a lot of the NGLs and LPG would come from the Middle East, would come from Kazakhstan. And as those volumes are diminished, that again puts the U.S. in a good position to continue to fill the void. And then as you look at ethane exports, again, staying at the highs, we see that remaining fairly elevated and well above the 5-year. Now, when we look at Fujairah had 21.919 million barrels, going up 581,000 versus last week. There was a rise in light distillate and heavy resid with a small drop in mid. Light distillate rose 405,000 barrels. Again, the East of Suez gasoline complex got a bit better going into May 29th. And it's just tracking gains that was happening in the U.S. U.S. gasoline prices were expected to continue to rise. And a lot of that is because of the lack of flows from Europe, which, again, will move some of those that product coming through. India's gasoline output fell 7.7% on the month to a 3-month low as domestic demand weakened, which again will put some of that product on the water. Middle distillate decreased just 19,000 barrels. But there's those macro concerns that continue to weigh on East of Suez gas oil, with some middle distillate sources saying that traders preferred to remain on the sidelines as they try to kind of play out what is happening in the financial world. The French strikes, again, are supportive in terms of the sentiment, because you're getting some additional product getting sidelined, left on the water. And then flat pricing is there. It's just a matter of no one really wants to get in front of it, with S&P Global reporting the possibility of lower Chinese gas oil exports in March and the onset of turnaround seasons. But the biggest issue is, well, as that happens and you do get that reduction, where does diesel, is that diesel flow going to adjust that and really kind of mitigate some of those bullish backdrops, which we think is likely. Heavy resid rose 195,000 barrels. Spot trading was active at both Singapore and Fujairah, but slowed as we got into the end of March. Most buyers were seen on the sidelines, again, just because they were trying to see what's going to happen with the underlying market, which continues to be a bit weaker. And traders were saw some disruptions in deliveries, which have slowed because of poor weather. But as that adjusts, we see, again, builds going up for pretty much all three of them as we go into the next few weeks. Then you look at the Brent time spread. You can see that things have gotten a bit, moved down in staying kind of in this fixed range. So we don't see too much happening at this point in time. Then when you look at some of the adjustments on the physical market, you can see that some of the different flows. The biggest one is going to be what happens with Russia. That's going to be the biggest shift. Libya is fairly stable, just over 1 million. We don't see that changing. Angola is something, again, right about 1 million, 1.1, with Nigeria actually increasing in May from 1.2 back up to about 1.3. And that's going to be an underlying issue, because when you start looking at underlying flows, Nigeria's is bereft, as there's oil strike, buyer strikes in terms of where it is. Around half of the nation's April crude still remains unsold. That is very high as we come into April. So again, that's a problem. And then when you look at Angola, they still have about 4 to 5 shipments to sell. And then Dieno, which is out of Congo, has 1 left out of 6, which is also slow. Senegal reduced its offer price for Gimboa. Again, which it's coming now to negative $4.10 below dated Brent. It was previously $3.50. Same thing continues to happen in other areas. Again, as they try to move product going into the fairly tighter period. Genscape, when you look at what's happening in Europe, again, fairly flat. We do see some of those increases. It's just going to be a matter of where are those flows really going. And then when you look at the underlying products, here's why we see a bit more of a slowdown. French strikes have slowed down and either or stopped refinery throughput, which will put more crude in storage. Then when we look at the underlying insights from Insights Global, coming from the refined product side, you can see that on a gas oil level, things have gotten a bit more back to normal. And as it's gotten back to normal, that's going to slow down some of their buying from the U.S., which is going to put more of that product, again, back into storage. And it's just going to be a matter of that balancing act because the U.S. has lost some of that demand going into Latin America as some of that Russian diesel comes down into Latin America, into Africa. And again, as because Europe also sent a lot of product into Africa, that's also being taken by the Russian product. So again, a lot of this is continuing to come back to those issues with Russian flows. Gasoline is at an all-time high, remaining well above COVID levels. So again, there's a big problem when you look at, how is that gasoline going to be there? And as the strikes continue and as the protests continue, people won't be doing as much, and that's going to keep a lot of that product there. And then back to the point of the inability of Europe to send that product into the broader markets, fuel oil continues to see builds as they struggle to sell. Singapore had a sizable build from 47.5 to 49.8. You can see it's moved back to the highs. It's the highest it's been for 2023. And there's only been 4 years where it has been higher on a holistic level. And just to consider, this is with middle distillates still at below the 19-year average. So when we look at light distillate, it's still at our seasonally adjusted record high. And again, that points back to more problems with demand, more problems with flows, and we don't see that adjusting. We look at middle distillate, as we've had 3 weeks of increases, this is the Russian product coming into the market. This is, again, Russia is taking market share, leaving other product unable to sell, driving additional builds into the Singapore market. International on the resid side continues to trend higher. And again, that's where more Russian products. So the resid and heavy disti side is at the highest storage levels of 2023. And given the increase in Russian flows and the slowdown in underlying demand, we see that continuing to go higher. Then when you look at North Sea continues to be at the low end. We start to see some of those builds happening along seasonal norms. And then as the slowdown into Europe, as the strikes continue, will also leave more of that product on the water, as Europe had a big increase. And that's why when we talk about some of those increases coming into on-land storage for Europe, this is one of the key drivers, because we're going to see some of those adjustments, and it's going to go from offshore to onshore, and that's where we're going to see some of those, again, bigger uplifts, and why we see more builds in Europe, both offshore as well as onshore. So that's what we have for you today. If you have any questions, please feel free to reach out. We'd love to hear from you. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.